Hi, it's Scott Garlis at Stansberry Research. I'm at the 2019 Alliance Conference here in Las Vegas with financial writer Diana Henriques. How are you?
Delighted to be here. Thank you.
Thanks for being here. That was a great presentation.
Thanks.
So the first question I had, what similarities did you uncover in your research between the crashes in '87 and 2008?
Well, there were a number of similarities, but what first got me looking for them was a conversation I had with Jerry Corrigan, the former head of the New York Fed, and he emphatically, pounding the table, said, you can draw a direct line between 1987, Black Monday 1987, and the 2008 crisis. I said, what, really? So I started looking through that prism and looking for what the similarities were. And once you start looking, they were fairly easy to find. The big one was, of course, the advent of brand new derivatives that nobody understood. In 2008, it was credit default swaps, right? How can we forget that? In 1987, it was S&P 500 futures and options, which no one understood. There were modern trading strategies in 2008, algorithm-driven investment strategies that were poorly understood but widely used. 1987, they called them index arbitrage and portfolio insurance, but it was the same thing. It was a computer-driven hedging strategy or arbitrage strategy that directed all of its users to do the same thing at the same time. Indexing was a fairly new thing in 1987, but growing faster than anyone realized and having an impact already on the market. Well, that was completely dwarfed by what indexing means in the 2008 market and what it means in the market today. So herd investment strategies was another big parallel. And of course, the biggest one of all is this fragmented regulatory system where one group of people regulates the derivatives and another regulates the stock market and another regulates sort of the bond market and somebody else regulates the banks that are lending to all of these markets, and nobody had the whole picture, had the whole 360-degree look. That was nearly fatal in '87, and it was nearly fatal in '08. We were blessed in '08 to have the leadership of Hank Paulson at the Treasury and Ben Bernanke at the Fed, who stepped into roles that were not defined for them. Neither of them actively regulated Wall Street as their daily job, but they stepped into those roles, much as the accidental heroes John Phelan and Alan Greenspan and Jerry Corrigan stepped into those roles in '87. So the parallels are rich and strong and I hope persuasive.
Yeah, just to your point on indexing and ETFs, it is kind of scary what they've become.
It is, and actually when people ask me, what scares you most about the market today, those are my answers. ETFs are bought and traded with little attention to their liquidity. And as I said, in a market panic, liquidity is the first casualty. It vanishes faster than you ever thought possible. The flash crashes that we've experienced, including the giant one in 2010, what was that? A sudden, inexplicable evaporation of liquidity. Well, an ETF, it doesn't matter what its portfolio is really worth. What matters is, can you sell it? And can you sell it in a panic? The answer to that is, how liquid is it in good times? And I know investors in my own family who buy ETFs without ever looking at daily trading volume, ever considering that there's any liquidity risk to ETFs at all. Index investing, as I said, is a much larger piece of today's market. And it's one of those sort of tragedy of the commons paradoxes. Index investing might be exactly the right thing for me to do or for you to do. But if everybody does it, it doesn't work because everybody will be buying the same 500 stocks at the same time, selling the same 500 stocks at the same time. So a market that becomes that homogenized with that much herd behavior is a highly unstable market in times of panic. So indexing and liquidity issues around ETFs are the two things that I think need desperate, sudden, emergency attention from regulators and from investors.
There's a recent ETF that came out, I believe it was a vegan ETF.
Mm-hmm.
It's full of like Microsoft, Intel, because they don't make meat products. That's the most ridiculous thing I've ever heard of.
And its daily trading volume, does anybody even know?
Probably not. Probably not. Okay, so cryptocurrencies. Do you think they're Wall Street's shiny new toy?
Well, Wall Street's always looking for something new to play with. We all know that because, well, why? Maybe it's the fees. Yeah, it might be it. But cryptocurrencies have had a harder time than I expected breaking down veteran Wall Street skepticism, which is almost a little bit encouraging. I mean, it's frustrating to me as an amateur financial historian that it seems like, society can learn lessons from history, but the financial markets have to reinvent the wheel every 10 years. I mean, we're always learning the same thing over and over and over again. But I'm seeing some prolonged skepticism about cryptocurrencies that makes me wonder if maybe we have, in fact, learned a little something about untested, unseasoned, illiquid investments. We can hope, fingers crossed.
Pretty much. Yeah. It reminds me so much of having been on Wall Street and watching the events of 2008 unfold, 2009, and you and I were talking about this prior, just how people didn't realize it wasn't, there were five of 6 parts. The liquidity was fine, but it was that last part of that instrument you were invested in that you couldn't get out of.
Yeah, and the expectation of always being able to sell when you want to is probably one of the most dangerous fixations that investors have. In the Brady Commission Blue Ribbon Report on the 1987 crash, they referred repeatedly to the illusion of liquidity. And markets market themselves this way. The New York Stock Exchange and NASDAQ and the Chicago Merc were telling the whole world how deep and liquid they were. So they were fostering that illusion of liquidity, that there will always be a liquid market. And in fact, some of the purveyors of those portfolio insurance products and those index arbitrage products, they too assumed liquidity. They assumed that when they were ready to make the sales that their hedging strategy required, there'd be a buyer. Of course there'll be a buyer, there's always a buyer. And then they discover on Terrible Tuesday, well, no, there actually aren't any buyers this morning. We cannot open these stocks. So the illusion of liquidity is a constant possibility in a marketplace and in a high-speed, algorithm-driven, computerized, automated marketplace surrounded by social media. I mean, thank God we didn't have Twitter in 1987, right? But in a world like that, liquidity can go in an instant.
Couldn't agree with you more. Does the algorithmic nature of today's market scare you?
Well, it does bear a strong resemblance to the algorithmic investment strategies that so compounded the difficulties in 1987. I was giving a talk at a major investment house, and the audience was primarily young people for whom they really needed the cliff notes for the decade that they'd missed, as I call my book. And one of them asked me a question. I was being interviewed by the chief investment officer for this Wall Street firm. He said, well, with all the quantitative investment strategies that we have today, they're so quantitative, they don't really have room for that human panic factor, so isn't the market much safer now? She and I both burst into laughter. I mean, it was just the silliest thing we had ever heard. I said, humans wrote those algorithms. Humans are going to have to step in to a collapsing market and figure out what happens next, not computers. So don't take any comfort in the idea that the algorithms, because they look so rational and literal and quantitative, that they are somehow buffered from the very human emotions. We've learned so much since '87 about behavioral finance, about behavioral economics, about the ways markets react to human reactions in real time. It would be a crime not to use that knowledge to address today's markets and look at algorithm-driven strategies in the light of, what happens when humans panic? How will they behave when humans panic? Because humans don't like strange things happening rapidly that have never happened before and seem scary. We don't like that. We run for the exits. And That isn't going to change. We've been doing that since the saber-toothed tiger was at the door of the cave, and we will be doing that when we're harvesting crops on Mars. But that's human nature, and any strategy that you're pursuing that doesn't allow for that is going to be misguided, and in the end, I think, ruinous to your success.
Fascinating stuff.
Thanks.
Thank you very much for your time.
Delight to be here.
Thanks for watching, and stay tuned for more interviews and updates.